You're watching Business Plus Weekend, a roundup of business and economy news of the week and what to look forward to in the coming days. Stories you must know this weekend. After bleeding profusely for one whole week, Adani Group stocks seem to be staging some sort of a comeback as of Friday. Adani Enterprises, after falling as much as 35%, closed 1% higher on Friday. What's more, 3 other Adani stocks also ended the day in green. But before Friday's trading session, the 10 listed entities of the conglomerate had cumulatively wiped out as much as $107 billion of the group's market capitalization in 9-day free fall. To put this in perspective, this number is equal to half the entire GDP of the state of Gujarat for the year of 2022. Now, prior to its fall from grace, the Adani Group stocks had collectively amassed an 800% rally in just 3 years. Its flagship, Adani Enterprises, had surged by 1750% from January of 2020 to December of 2022, as against Nifty's meager rally of 49% during the same period. Then came the Hindenburg Research report, accusing the group, and I quote, of brazen stock manipulation and accounting fraud. Adani's house of cards collapsed and continues to collapse. Adani was forced to call off its much anticipated FPO.
Considering the volatility of the market seen yesterday, our board strongly felt that it would not have been morally correct to proceed with the FPO.
Of the total $107 billion loss in market value to the group, Adani Total Gas was the worst hit, losing over $29 billion in the turmoil. Meanwhile, the group's flagship company, Adani Enterprises, eroded by over $26 billion in market value. Other major losers include Adani Green Energy and Adani Transmission. Both have eroded investors' wealth by as much as $16 billion each. Joining us from the newsroom is R. Sridharan with his perspective. Shri, I want to ask you, what's next for Adani Hindenburg saga? Will it end up in litigation? And if so, what lies ahead for retail investors?
Well, Shweta, the point is the Adani Group has already lost more than $100 billion in market cap in the last just 1 week. So I don't think any kind of litigation is going to make good those losses, and there's anything to be gained for the Adani Group or Mr. Adani personally by getting into a litigation with the Hindenburg Research Group. What I think might be more constructive from the Adani Group point of view is to address the perception or the actual issues that may exist, which have been highlighted in the Hindenburg Research report, and then start putting systems in place which gives investors greater comfort. So I don't think there's going to be any significant litigation, or even if there's a litigation, anything significant is going to come out of it which benefits the Adani Group. I think Mr. Adani would want to, first of all, tide over this difficult situation and then start looking at what does he need to do to bring the investor confidence back into the Adani Group stocks, which have taken a severe beating over the last 1 week ever since the report came out.
All right, so it's going to be wait and watch out for Adani. But stepping into 2023, Gautam Adani was the 3rd richest person in the world. Today, he's not even in top 20. Adani has gone from being the biggest wealth gainer in 2022 to becoming the biggest loser on the Bloomberg's rich list this year. Gautam Adani's personal wealth stands at about $61.3 billion as of February 3rd. This is over 48% lower than $119 billion he was valued at as of January 24th when the Hindenburg report came out. Now, Hindenburg's report on Adani Group was over 2 years in making. During this period, Gautam Adani's wealth increased from $10 billion to $119 billion. Since the beginning of 2023, however, Adani's personal wealth has just almost halved. In the last 1 week alone, his net worth has collapsed by over $10 billion. He is now the 3rd richest man in Asia and the 2nd richest man in the country behind Reliance's Mukesh Ambani. And as shares of Adani Group continue to tumble, there are growing concerns over its implication for the financial stability of Life Insurance Corporation, the LIC, and State Bank of India. Both LIC and SBI have significant exposure to Adani Group. However, it is said to be within the regulatory framework. After the shares of Adani firm fell sharply on the back of Hindenburg research report, it was feared that the stock value erosion may have exposed India's financial system to systemic risks. The RBI stepped in to take stock of commercial banks' market exposure to the Adani Group. Now, according to a disclosure by LIC, its exposure of over 36,000 crore rupees to Adani Group's debt and equity is less than 1% of the national insurer's total investments. India's largest public sector lender, SBI, has given loans worth 21,000 crores to Adani Group companies. This amount is half the maximum exposure that SBI can have to a single group under the current RBI rules. Now, RBI allows for no more than 25% of a bank's available eligible capital base to be exposed to any one group of connected companies, and SBI says that its exposure to Adani Group is below the large exposure framework of the Reserve Bank of India. The matter has now reached Parliament, where the opposition parties demanded a debate and called for a joint parliamentary committee to probe the Adani saga, which is currently ongoing. Meanwhile, regulatory concerns are also mounting for Adani Group. The damning allegations made in the Hindenburg report have led to a total losses in the 9 listed Adani Group of companies of more than 100 billion in market value. In addition to RBI probing banks about their exposure to Adani firms, the Indian market regulator, the Securities Exchange Board of India, or SEBI, is also said to be studying the developments very closely, and that's adding to the regulator's own ongoing preliminary investigation into the group's foreign portfolio investors. The National Stock Exchange has decided to place 3 Adani Group stocks, Adani Enterprises, Adani Ports and SEZs, and Ambuja Cement, under additional surveillance. S&P Dow Jones said it will remove Adani Enterprises from the widely used sustainability indices with effect from 7th of February. Gautam Adani is a familiar name in Australia, where his group operates the controversial Carmichael coal mines in addition to a rail project in Queensland, and the country has now taken a note of Hindenburg report. Australia's corporate regulator said that it will review the concerns raised in the report. Global investment firm Credit Suisse also assigned a zero lending value to bonds issued by Adani entities, expressing its lack of confidence in the financial health of the bonds' underlying assets. Citigroup, another international lender, joined in as it announced it will stop accepting Adani entities as collateral for margin loans. And that's indicative of a larger scrutiny of Adani Group of companies. Fitch Ratings, however, said that there is no immediate impact on Adani entities and their stocks, as it expects no material change to the cash flow. And moving on now, in a major setback for our neighbor Pakistan, the International Monetary Fund has refused Pakistan's bid to top up its bailout package, leaving the country's economy high and dry. The IMF's review mission had arrived in Islamabad for a last-ditch effort to revive the vital financial support which has been lying stalled for months now. The IMF rejected Pakistan's revised circular debt management plan. Now, reacting to the development, Pakistan Prime Minister Shehbaz Sharif termed the bailout conditions laid out by the IMF as beyond imaginable. Both sides will continue to hold talks to complete the pending 9th review under the $7 billion extended fund facility. Pakistan government till now has been holding out against IMF's demand for raising taxes and slashing subsidies, fearing a backlash ahead of elections that are due this October. Pakistan finds itself in dire straits, one more time hit by another balance of payment crisis. Pakistan's central bank pegged the country's reserves just enough to service less than 3 weeks of imports. Meanwhile, Pakistan's inflation quickened to its fastest almost in 48 years in January of this year, as thousands of containers of food items, raw material and equipments are stuck in ports after cash-strapped government curtailed imports. Pakistan inflation is at highest since 1975, according to central bank data. And moving on now, in the US markets, the Meta stock saw its biggest single-day gain in almost a decade. Meta jumped by a whopping 24% to $198.54 in the New York Stock Exchange. Meta, on the rebound after worst year for its stock in history, stands in stark contrast to other tech companies that have seen their stocks getting punished for disappointing outlooks. Now, Meta's best performer in the S&P 500 index since the stock's recent low in November, gaining 54% after the company reported fourth quarter revenue that topped estimates and announced buyback. In contrast, the results posted by Apple Inc., Amazon and Alphabet Technology, with a combined market value approaching $5 trillion, show an economic slowdown is throttling demand for electronics, e-commerce, cloud computing and digital advertising, mainstays of the global tech economy. But Meta has countered the slump with some tough measures that included a cut of 11,000 jobs, or 13% of its workforce, that it undertook last November in its first ever major layoff. In a call with investors, CEO Mark Zuckerberg said that 2023 is going to be an year of efficiencies. He said that the company is working to flatten the organization structure, removing middle management to make faster decisions, and also work to deploy more AI tools. Bloomberg data says Meta's stock surge is the biggest contributor to Nasdaq's hundreds rally on Thursday, adding more than 10% to the benchmark index's climb. And that's all we have in this edition of Business Plus. For more incisive news analysis and cutting-edge documentaries, keep streaming News 9 Plus. Thanks for watching.